My name is Carl Williamson. I'm talking to you from Quilter Cheviot offices in London. It's March 2022. I'm the manager of the Nexus Global Solutions portfolio and the Nexus Global Dynamic portfolio. Clearly it's been a volatile period, with concerns about interest rates being overtaken by events in Ukraine. In February, the Nexus Solutions portfolio was down 2.4%. Year to date, the portfolio is down 6.4%. The Nexus Dynamic portfolio is down 3.5% and year to date is down 8.6%. As a reminder, the Nexus Dynamic portfolio is entirely invested in equities. I don't have a strong view on Russia's tactics over the next coming weeks and months, but what we can do is try and analyse what it means for the companies we're investing in and what it means for stock markets in general. The biggest impact is on energy and commodity prices. Russia plays an outsized role in both the oil and gas markets, and perhaps less well appreciated is that from Ukraine and Russia, the world gets around a third of its wheat production. This is an issue because global central banks have been looking to put up interest rates because inflation has been rising. Clearly, these rises in oil prices and gas prices we've been seeing are going to make this a more tricky decision. They will have an impact on global growth, but at the same time inflation will be rising, and so the central banks are now going to have a difficult decision as to how they put interest rates up. Markets have been weak on the back of this. There are certain sectors that are benefiting, such as commodity stocks, but other markets have fallen, and in particular those markets closest to the problem, i.e. Europe, have suffered more than other regions, such as the US. The portfolio has no direct exposure to Russia and very little exposure to emerging markets, so we haven't been as exposed to these areas and the issues there. We try to focus on what we can analyse, and so we're sitting with our analysts and looking at the companies that we're investing in to see how it will impact on their business going forward. We haven't made too many changes to the portfolio. We continue to take a long-term approach, and with a focus on quality growth companies, we feel these companies will be able to weather the storm. We have exposure to the oil companies and mining companies that have benefited recently, but we don't think it's a time to be moving a large part of the portfolio to cash. This month, a focus on developed markets has helped the portfolio, as the US market has held up better than some other regions. Unsurprisingly, commodity stocks have performed well recently, including the likes of Chevron and Rio Tinto and the recent addition of Anglo American. Given heightened concerns about cybersecurity, Palo Alto was one of the best performers during the month, up 15%. Perhaps less well appreciated is that renewable stocks have been doing very well because of the concerns about energy transition and energy security. So one of our holdings in that sector, EDPR, performed very strongly against the weak market in February. In previous military crises we have looked at, most markets were flat 1 month after the conflict started and were actually higher 6 months afterwards. This includes the Gulf crisis, where again oil prices were higher because there were concerns about supplies going forward. Global inflation is likely to be higher over the coming period and likely to be stickier because of higher oil, gas and commodity prices. If the crisis is prolonged, clearly stagflation is a risk, but at the moment this is not our base case. The crisis is likely to depress growth and impact on consumer confidence. This argues for a bias towards quality and companies with strong balance sheets in the portfolio. This year, central banks have talked up the need to raise interest rates to combat inflation. Clearly, the rises we've seen in oil, gas and commodity prices is going to complicate this job. There is another impact in that higher commodity prices does impact on disposable income, which could dampen growth going forward, in part doing the central bank's job for them. While it's unlikely that the UK and the US will abandon their stated intention to raise rates, it may be that they will be less aggressive than they have indicated in the beginning part of the year. Thank you for listening, and I look forward to speaking to you next month. Rest assured we continue to monitor the situation closely, and if you have any questions, do let me know.